Chairman Barr, Ranking Member Foster, and members of the subcommittee, thank you for the opportunity to testify today. My name is Bill Nelson, and I am the Chief Economist of the Bank Policy Institute. Prior to joining BPI, I was a Deputy Director of the Division of Monetary Affairs at the Federal Reserve Board, where I helped develop the Fed's discount window policy and oversaw the lending operations of the 12 Federal Reserve banks, including regular discount window lending to banks and emergency lending to non-banks. The Fed extends discount window loans as collateralized advances under the authority granted under Section 10B of the Federal Reserve Act. The loans can generally be extended for maturities of up to 4 months and must be secured to the satisfaction of the lending reserve bank. Most discount window collateral is pre-positioned at a Federal Reserve Bank, and 80% of that collateral is loans to businesses and households. Most central bank lending to banks is unremarkable. Prior to the global financial crisis, discount window lending was an important tool for monetary policy implementation. If the Fed inadvertently left the system short of reserves on any given day, the Fed funds rate would rise up until some bank borrowed, creating more reserves. Smaller banks borrowed to address short-term funding needs, such as might be caused by losing a large municipal deposit, for example. To be sure, the discount window is also and has always been the Fed's first line of defense against broader financial turmoil. In part because of the dual nature of discount window lending, both unremarkable monetary policy tool and source of contingency funding, there has been a stigma associated with borrowing from the discount window at least since the 1920s. Tapping your contingency funding inevitably suggests something has gone wrong. Stigma got much, much worse in the aftermath of the global financial crisis when borrowing from the discount window was conflated with having received a bailout, even though the loans were fully collateralized, extended at an above-market rate, and all repaid on time with interest. Because of the pillaring banks that borrowed received, many banks now refuse to borrow under any circumstances except perhaps an obvious glitch affecting the entire payment system. Consequently, one of the Fed's most important monetary policy and financial stability tools doesn't work well. Another source of stigma is that the post-GFC liquidity requirements do not recognize access to the discount window and pre-positioned collateral as a source of liquidity. Banks are not allowed to assume that they borrow from the discount window in either the liquidity coverage ratio or their internal liquidity stress tests. Not only do these restrictions depart from reality, a bank prepared to use the window is more liquid than one that isn't. They miss an opportunity to create a strong incentive for banks to be so prepared. Moreover, efforts by the banking agencies to convince banks that they should be willing to borrow from the discount window ring hollow if banks are told that contemplating such borrowing is verboten when the banks test their liquidity needs under stress. In the wake of the bank failures in spring 2023, there has been an increased recognition of the importance for liquidity risk management of being prepared to borrow from the discount window. There appear to be several different approaches floating around for encouraging such readiness, but all involve requiring banks to have discount window borrowing capacity that, when combined with deposits at the Fed, exceeds some proxy for short-term funding needs under stress. A common thread across the proposals is a recognition that a bank that is prepared to borrow from the discount window is more liquid than one that isn't, and that weaving that thread into the weft of regulatory and supervisory assessments of bank liquidity will make those assessments more accurate and increase incentive for banks to be prepared to borrow. A critical ingredient of any such new requirement is reducing discount window stigma. While there is no easy way to reduce discount window stigma, as a first step, the leadership of the Fed and other banking agencies need to educate the public, Congress, bank examiners, and bank investors that borrowing from the discount window is a business decision of the borrowing bank and neither a bailout nor an indication that the bank is in trouble. Any requirement that banks maintain minimum amounts of discount window borrowing capacity would, of course, need to go through a notice and comment process. In this case, given the novelty, importance, and systemic implications of any such requirement, a better approach would be through an advance notice of proposed rulemaking, which would allow the agencies to receive input on the general idea from bankers, central bankers, academics, and other stakeholders before drafting a specific rule. Thank you. I'd be happy to answer any questions.